3i about the state of the buyout market, what venture capital and private equity companies are likely to do over the rest of the year here as we come through this period of tight credit markets. Peter Lenardos has joined us. He's a Director of European Research at Churchill Capital. Peter's been helping us put some numbers on exactly what is going on in the M&A market at the moment. Peter, welcome.
Good morning,
Good
Jeff.
to see you.
Good to see you.
So you've been digging into the statistics, and what do they indicate for us?
The markets so far in 2007 have been extremely buoyant. When you look at global and then the main powerhouses, U.S. and Europe, I mean, M&A activity is up tremendously in Europe, you know, over $1 trillion U.S. dollars, in the U.S. over $1 trillion U.S. dollars. It's clearly going to be a record year, and that's fueled in part, as you said, by sponsor buyout activity. Now, I think the key thing to note here is in the United States, LBO activity has taken up 45% of the M&A activity. In Europe, that's only 12%. It's actually contracted a bit. Now, has it grown? Of course it's grown, but I think strategic activity has grown quicker. So I think the M&A markets will still be buoyant. There's still a lot of cash-rich companies. There's industries that are still going to consolidate. So it's been a heck of a 2007, and I think this direction that we're seeing thus far at the end of July and so far in August has been natural and healthy for the markets.
And we've been talking a little bit about how the leveraged debt market is going to make life difficult. Clearly, you put some numbers now on where it is most important. One takes away from that, hopefully, that Europe will continue to be strong, given how low the percentage of involvement from leveraged buyout has been.
I would agree with that, and I think another thing to look at, Jeff, is that these LBO houses are still out raising money. I mean, despite the credit turmoil, you're hearing the largest European funds are being raised as we talk. That capital needs to be deployed somewhere, and I think we're going to not only see the strategics continue. Look at all the largest deals in Europe, the ABNs, the Capitalias, Altadis. I mean, Alliance Boots would be the exception here. Those have all been strategic acquirers. You're going to see cash deals. You're going to see cash-rich companies making acquisitions, and I think for LBO houses, what you're going to see is what happened with Cerberus when they bought Chrysler from Daimler. You're going to see a lot of parent company financing as well.
Just on the levels of the deals, John Moulton was on guest hosting from Alchemy, and he said, look, 500 million is going to become the cap here because you're going to need a lot of leverage finance above that, and it's just not going to be in the market for some period here. Do you buy that? Do you agree with that? Does that sound likely?
I really don't, because when you look at average deal size, those are up almost 100% from last year. The average deal size, even in the LBO space, is now between 500 and $1 billion US dollars, and I really don't think we're going to be capped here. I think what we're going to be capped at is going to be the level of debt that we put on companies. Instead of seeing the 8, 9, and 10 times, and in the case of Univision in the U.S., 12 times, I think you're going to see those numbers come down to more historical levels. You know, 4, 6, maybe 7 would be aggressive now. So I think the equity component is going to need to be a lot higher, which of course is going to bring returns down. If you look at the last market shakeout, though, the 2000 market shakeout and the terrorist attacks of 2001, which really kind of made the markets turbulent, what they did there was they brought these debt levels down a lot, and they brought the private equity houses, their expectations of returns a lot more realistic. It used to be in the 90s that a private equity house would want a 25% IRR to go on a deal. Now that's more 20%. I think that you could see that those numbers could contract a little bit as private equity houses are forced to deploy the capital that they have.
Steve, come on in.
Peter, nice to see you this morning.
Thank you.
While there's been an incredible ascendancy of private equity percentage of deals, of total deals over the last couple of years, I'm just wondering if this current shakeout is going to mean that that ascendancy draws to a halt, and we're actually going to see, going forward, industry and buyers from, let's say, state-owned funds as well, gaining a larger proportion again. Have we seen the best days in terms of percentages of private equity controlling these international M&A deals?
Great question. I think we've clearly seen some good days. I think it was key to note that in 2007, when you had private equity houses that were acquiring or attempting to acquire airlines and utilities, two sectors that the private equity industry typically stays away because of heavy regulation and heavy capital investment, I think you could be seeing that we were at a top there, and that the debt markets were very buoyant, money was very cheap, it was almost free money, and the amount of leverage we were putting on was just an incredible amount. So I think it's going to take a lot more operational experience to make money in the private equity field. Have we seen the best days? We've seen some good days, but I think that private equity is a very mature industry. They have a lot of money, they have a lot of smart operators in there, and I think they're going to continue to acquire and make smart plays. I think they will be a little bit more selective, though.
Louisa.
Peter, hi. Good morning.
Morning.
What will the involvement of Asia be? What do you think China's involvement will be, some of the other Asian countries as well? Is this kind of their turn to step in and either lend money or get directly involved in, say, for example, some of these large private equity deals?
So that's a great question. You've already seen China get a lot more aggressive. You've seen Temasek out of Singapore as well become more aggressive as well. And even Dubai, as Jeff was just talking about with the exchange and OMX, they're becoming increasingly aggressive as well. I think these cash-rich Asian countries that have capital to deploy will take an increasing role here, not only in Europe but in the United States as well. I think that it's fair game on a global basis that these governmental entities could begin to make a lot of money and play an increasingly large role on the global stage.
Patrick?
I think, I mean, it's a fascinating landscape, Peter. I mean, the other thing I guess that's interesting is what happens to those companies that were planning an IPO, and I guess from a 3i point of view, we've been quite interested in, we're seeing already a number of opportunities where you had reasonably sizable private companies thinking of IPO, not IPOing. So private equity isn't just about buyouts.
Right.
You know, private equity financing can supply a whole range of things. So when debt gets tight, equity gets harder to get, more expensive. That's an interesting opportunity for us too. Are you seeing much of that?
Well, I think that's a good point. That the successful point of a buyout is not only entering the exit, the opportunity, but also exiting as well. And I think that you've already seen some IPOs delayed. You've seen equity valuations come down. I think fundamentals are still there. I think there's a dearth of liquidity in the market. So I think that is going to be an issue as well. That a private equity house is going to have to think if they enter into an investment now, how are they going to get out 3 to 5 years? You know, it might not be that IPO, it might be the secondary or a third private equity market, and it also might be, you know, a sale to a strategic acquirer. I think is going to have to become a lot more prevalent. So it's going to take more brains and more thinking prior to entering that investment opportunity. It's going to be interesting.
I think that's right.
Sectors. Just before we let you go, Peter, I think it'd be useful. Where do you think there is still going to be robust activity, even if this credit squeeze continues here?
Sure. Finance, without a doubt. I think real estate as well. They've been very buoyant, very robust. Telecom, I think it's always a sector that's innovating, that's growing, and therefore is consolidating as well. And I think that utilities and energy, you know, they've been very robust for the past 2 years, and I don't see that slowing down, especially since on July 1 the EU liberalized the energy market. So I think finance, real estate, utilities and energy, and probably telecom as well.
Great conversation, Peter. Thanks very much for coming in. Peter Lenardos with us from Churchill Capital, Director of European Research there. Patrick, 3I's